thing that worries me is if you're a new investor, you think this is just what it's like all the time. And this is not what it's like all the time. It's like the market goes in these cycles and these swings. And like the concerning thing is maybe in particular with like ASTS and IREN and a bunch of other young companies, we don't actually know if they're going to become like big behemoths. We might be really confident in their mission and where they are and the maturity and all of the thesis might be really strong, but they're still young, tiny companies. They can still fail. And they're more likely to fail than something like a Amazon or an Alphabet, which is like established, like very, very established. And the trouble is, you've got, say, let's say quantum computing, right? You've got dog shit stocks. I'm sorry if you like quantum computing. If you do, I disagree with you. That's fine. You've got great companies and you've got terrible companies, and they're all going up. And when you're in the middle of it, it's quite hard to tell the difference. And even I don't know the difference. Like ASTS and IREN, one of them might succeed and one might fail. And if you told me that was the outcome, I couldn't tell you which was which, right? I don't know today. I've got to see how it plays out. So I feel a bit safer owning those two because they are like two stocks among 30 stocks that I own. And I'm pretty well diversified. And my bigger allocations are in my more established positions. And I got smaller amounts in the more prospective stuff. I know you do things differently. And like, tell us about your strategy and why you're more comfortable having like larger allocations in these smaller companies. But even then, you're pretty diversified, right?
Okay, boy, there's a lot there. Let me actually take it one step back, and maybe in order, I think, of importance. Forget IREN for a second and forget AST. I think there's a bigger point. And you name dropped this ticker appropriately, I think, Amazon. Here's I think what new people will not know because they don't have the experience. When you invested in Amazon early, and that could be actually any number of years, if you had a time machine to go into the future, would have been like, oh my God, I was a genius to have invested in Amazon. Because yes, you would be a multi whatever, right? Millionaire, billionaire. What beginners miss is that Amazon dropped something like, what was it, 80%? 80, 90, whatever. It doesn't even matter. The point is, it dropped way more than you think is even possible. So all beginning investors should mentally assume the following. You've done your research, you picked Amazon or today's version of Amazon. Let's call it whatever, but Banana Incorporated. And you're right because your research was right, but then you forget that you don't go in a straight line from whatever $5 a share to $2,000 a share. In between, you will have something like a potential 80% correction. So now if you're a beginner and you wake up tomorrow or a month from now and you see that Banana Incorporated, which you are so confident about, now dropped 80%, what are you going to do? And how are you going to feel?
You're ripe for panic, right? When you're in that situation, particularly if it's the first time you've seen that happen. You haven't got like the battle scars of experiencing it over 10, 20 years.
Right. And one of the things you're going to do is you're going to say, I was wrong. Right. And the way you're going to say that is actually maybe not to yourself but by pressing the sell button, which is the classic buy high, sell low trap. So maybe what we're trying to say, as per last episode, is do the mental work to prepare yourself for the quasi inevitable correction, and then double check that you're not going to be selling out of panic, but rather understanding that this is just how things be. And really, at that point, the only, I think, serious decision would be, is this a good time to add more? In which case, I would then bring in my technical tool set and kind of wait and pick my moments to dollar cost average rather than just do it because I feel like I should have more shares now. But that's a side issue. It would be anything but selling if nothing has fundamentally broken.
And yeah, and doing like certainly doing nothing just like that because the price moved up or down. It's like go back to your plan. What was your thesis? Maybe if you use technical trading indicators, you go and review those. Maybe if you use fundamentals, you go back and reread like the last quarter results. Maybe stick the next quarter in your diary and put aside like 2 or 3 hours to review that quarter when it comes around. But just reacting because the price moved, that's almost always going to be a mistake.
Right. And actually, to bring it back to ASTS at the moment, it's a pre-revenue company, for one. So my whole investment thesis badge is not based on something like, discount cash flow models or multiples. It's primarily, almost entirely thesis based in terms of narrative. So I have that story completely locked down. If the price were to drop 50%, that is irrelevant from the thesis statement. It allows a better valuation and all of that. But why? It's almost inverse. Why would I sell at a better valuation if it had nothing to do with the story? So point being, people confuse price with value in company and so forth. So I would actually in some ways welcome a huge correction to ASTS because I could buy more shares before the actual thing starts playing out.
Right, exactly. Now, don't just take our word for this, because you may have heard of Peter Lynch, like legendary investor. Now, he doesn't make live appearances often. You don't see him on interviews. He was a big guy. He ran something called the Magellan Fund, did like incredible market-beating returns for decades. But he retired from that in the 1990, I think, sometime around then. And he's kept a pretty low profile since then. But he just did an interview this month with an incredible podcast called The Compound and Friends. So we're going to drop a link to The Compound and Friends episode 211 in today's show notes. Don't take our word for it. Go listen to this interview and take Peter's word for it. And so, let's just pull a few lessons out of that Compound and Friends, because I think Peter Lynch's approach is really aligned to the way we think about stocks. And it's probably not coincidental, because I've not read his classic book. Was it One Up on Wall Street? But certainly the lessons from that have infused me, because I've got them from other, I've probably read your own writings on that over the years when you used to write for the Motley Fool, right? I've soaked this stuff up, and it's certainly core to how we talk about being a long-term investor. Like Peter is so focused on know what you own. Like if you don't understand the companies you're invested in, you're much more likely to panic sell when the stock price goes down. He's a real advocate for researching.
Actually, Badge, can we unpack that a little bit?
Please.
It seems simple, know what you own, but I found that the way this happens for me is over stages. Like it's not like all of a sudden I go from not knowing a company to all of a sudden I know everything. It's more like once a company shows up on my radar, then I just systematically keep learning about it, and I keep, maybe if it's a product, I then eventually get the product, or I ask people about it. But it takes months. Often, like it takes months. There are some exceptions where I myself was fanatical about the company. Actually, only two really come to mind, which would be Apple and Tesla, where I just, I knew those things because I was fascinated by the company, by the culture. And so I knew I had hundreds of hours or thousands of hours of, reading about it. But more, usually it's like, okay, Lululemon, okay. Do I want this? Do I not want this? Oh, I'll go into a store, right? But that takes time.
Yeah, you're right. And there's like an easy structure to build that knowledge over time, but it takes time, and it just takes, refreshing your due diligence. In today's episode, I'm going to show you how to look through a set of quarterly results. It's about doing that every couple of quarters, at least once a year, but ideally a bit more frequently, and just like build your knowledge of the thesis. Look at the competitive landscape. Go into the Lululemon store and look at what's on the shelves and look at how busy the store is, and then, check out like this summer's line of clothing, and does that fit your idea of what people are going to want to be wearing? It's that kind of stuff.
Right. I mean, it's not just that simple, but it is the most obvious and non-complicated place to start. If you then walk into the store and you don't like what Lululemon is selling, then why would you invest in it? I mean, really, like all of a sudden, then you're swimming, upstream, which is just not wise. Badge, could I talk about the second point on the docket here? Lynch says, avoid playing the market. Investing isn't a game. It's about buying good companies you understand. So that's a little bit of a segues with the first point. I would reword this differently, as you know. I would simply say, know the game that you're playing. And if you call yourself an investor, then do all this stuff about understanding the company and the fundamentals and knowing the product. If you're interested in something outside of investing, which I would call either swing trading or momentum trading, then you first have to say, this is what I'm doing. And then I would still go and understand the company, especially in the swing trade stuff, because that takes months sometimes to unfold, months or even a year or so. But I'm not so prohibitive about avoid playing the market. It's just a different thing.
Yeah. And actually, one other point, like later in the interview, that Peter brings up is, which I'm terrible at, I think you're potentially quite good at. He says, like, be open to investing in less glamorous companies. Like sometimes looking for companies that are improving from a like crappy to semi-crappy to better to terrific is like a good journey. And if you can catch them at the crappy stage, but you can see that trajectory, like I'm terrible at that. I'm always like poo-pooing. It's like some of your like, I call them like, like your bottom of the barrel ideas, but if they're on the right trajectory, then it can still be a legitimately incredible investment.
Right. Multiple ways. This is great news. Multiple ways to win in, let's call it, in broad strokes, in investing. One is to do what you do primarily, which is in this, I'm going to simplify a little bit, but you're not trying to be smarter than the market in a sense. You're buying excellence. You're acknowledging that excellence tends to remain excellent.